Meta didn't forget how to make money. It produced $31.86 billion of operating cash in Q2, then spent almost all on property, equipment, and lease payments for the buildout. Nearly $61 billion of revenue ended with $784 million left. The cash engine worked. Construction swallowed the result. You saw investors mark down the stock before its first payoff receipt. By August 24th, Meta was $559, 29% below its yearly high of about $791. That drop is why you are here. Correction or bargain? No automatic bargain. My early answer is conditional. Meta clears the normal bar and fails when I demand extra cushion for an unproved AI build. First payoff. Cash from the business rose almost 25% year over year. The ad machine did not collapse. The squeeze happened after the cash arrived. That changes the question. You are not deciding whether Facebook and Instagram work. You are deciding whether Meta can turn its servers and data centers into enough future profit to justify their cost. Business, price, and chart do not line up neatly, where expensive mistakes hide. This is the discussion. Meta is still overwhelmingly an advertising company. In Q2, ads supplied about 98 cents of every revenue dollar. Think of Facebook and Instagram as a toll road built out of attention. Advertisers pay for the traffic, and that cash funds whatever Meta builds next. The toll road is busy. Ad revenue grew 27%. Impressions rose 14%, and the average price per ad rose 12%. I honestly expected one lever to be soft after the sell-off. Both moved up. The cleanest answer to anyone saying Meta's core business is broken. That 98% cuts both ways. One product at enormous scale built these margins. If advertisers blink, there is no second engine. If this filing check saves you time, a like tells YouTube to show it to more investors like you. So who is actually making this bet? Zuckerberg also controls about 61% of the votes. This build is his call. But the company is changing shape. It is becoming a profitable ad network, tied to power-hungry infrastructure. It is like a restaurant, building the power plant next door. The dining room can stay excellent, but your bill now depends on whether that plant earns anything. So the stock question is narrower than, is Meta cheap? Does the lower price pay you enough to carry one company's execution, legal, and infrastructure risk instead of owning a basket? First reframe. A bargain pays you for the risk. That is the frame. Next question is what the build actually costs. The filing starts with an absurdly strong operating cash engine for a company this large. Then came $30.12 billion for property and equipment, followed by just under $1 billion in lease principal. What remained was $784 million. Free cash flow is what remains after running the business and paying for long-lived equipment. Your paycheck after the mortgage and new roof. The figure is real. Servers cost real dollars. You cannot add them back because the purpose sounds exciting. But saying Meta only made that amount is incomplete. It generated more than $31 billion before the build. Both are true. Headlines flatten the split. The pressure can last. Meta expects to spend $130 to $145 billion this year on the infrastructure behind its plans. The filing disclosed $349 billion of non-cancelable commitments. They are not all debt, and I do not stack separate lease categories on top. Still, a long contract, not a weekend renovation. One more consequence for you. Meta paid $1.35 billion in dividends and equivalents that quarter, $569 million more than the free cash flow left after the build. One quarter does not make the dividend unsafe, but cash promised to owners was larger than cash left after the build. The balance sheet covered the gap. Mini read: healthy cash engine, much heavier trailer. Can its old quality record carry it? This is what I am seeing. Meta's historical health screen scores A, 88 out of 100. Strong report card, not a promise. Return on invested capital asks whether the machine produces more than each dollar tied up inside it. The latest reading is about 22%, and the 5-year pace is about 18%. Historically, Meta has been very good at putting money to work. One limit: the scorecard lacks a 10-year ROIC point. 5 observations are not a decade. I will not pretend a shorter ruler measures the whole wall, so I hold this row looser than the others. Revenue is the clean row. Its latest annual window is about 22%, not the quarter. Q2 itself grew 28%. Either way, demand is not the problem. The warning rows are earnings per share and free cash flow. Their latest windows are slightly negative and roughly negative 15%. One red box does not erase the history, but direction changed. Think of the A grade as last year's physical. The patient is fit. The Q2 cash result is the ankle brace you noticed walking in. Business verdict: strong engine, proven ads, unmeasured new load. Green on quality, but it does not settle the price. The model starts with the analyst earnings path from the matching data provider. It expects about 22.5% annual growth for 4 years. That forecast is the bet, not a filed result. Its earnings basis may not match SEC-reported earnings line for line, so I keep it inside this model. The cases get planning weights: a quarter downside, half base, a quarter upside. They are my judgment, not your odds of making money. The downside case grows earnings near 20% early, then 3% later. Buyers pay about $16.50 for each earnings dollar at the end. Even the downside asks Meta to execute. It is cautious only beside the other cases. The base case uses about 22.5% early growth, then 10% later. Buyers still pay roughly $24 for each earnings dollar a decade from now. It is a relay race. Analysts run 4 laps. Then, a slower assumption takes the baton. Drop it, and the finish line dollar is decoration. Today, you pay about $17 for each dollar Meta is expected to earn over the next 12 months. The base case assumes 44% more. That is not earnings growth. Buyers simply like Meta more. Half the model rides on a mood I cannot forecast. It may prove right. The filing cannot prove it for us. The upside case lifts early growth to 27%, then holds 12%, with buyers paying about 28 times earnings. Great future, least forgiving one to call normal. Now the range shows what those assumptions cost today. The full forward range, one stretch. Downside, $302.45. Base, $717.44. Upside, $1,064.61. Weigh those good and bad futures together, and the odds say $700.49. The market price on August 24th was $559.02. The spread is the point. Downside sits almost half below the market, while base and upside sit above it. This is a weather map, not one magic answer. At the normal 12% return bar, the model estimates about 14.6% a year. That clears. The price looks undervalued under that standard. Raise the bar to 15% because you think this build deserves extra uncertainty, and the model falls to $537.78, below today's price. The part my own work adds, not the earnings headline, is that the same stock clears one honest bar and fails another. Value verdict: 700 under the normal standard, 538 under the strict one. Same company, same day. Two honest answers. The bull case starts with proof. Ad revenue grew while volume and price improved. This is reported demand paying today's bills, not a future product promise. Management says its Advantage Plus ad tools are running above $75 billion annually. More than 9 million small businesses used an AI creative tool. Some AI benefit already rings the cash register, not a science fair project with 0 customers. But I cannot verify those tools' profit against the broader system's cost. Meta disclosed no company-wide return on the build. That missing receipt decides the argument. The bear case: the build absorbs growth faster than owners feel it. Family of apps revenue rose 28%, while operating income fell 6%. You are filling the bathtub faster while opening a wider drain. Some pressure was unusual. Meta recorded $2.4 billion of legal charges and $1.18 billion of severance. Company-wide, management says operating income would have grown 9% without them, instead of falling 8%. Fair counterpoint, but 9% is nowhere near 28%. The plumbing stayed more expensive after removing the 2 loudest leaks. There is also a risk no spreadsheet settles neatly. A youth safety and privacy trial involving 29 states began on August 18th. Meta denies the allegations. I cannot tell you how that ends. Research did not source the next milestone. A material penalty or product change could hit cash and engagement. Your strict bar has to carry that uncertainty. The strongest bull says today's ad engine finances tomorrow's products. The strongest bear says those products make the engine permanently costlier. Neither side gets deleted. Price is voting with the skeptics, and the chart is not subtle. Chart numbers are from the August 24th close. Price was $559.02, below both moving averages. The 50-day average was about 593, the 200-day was about 624, and the faster line sat below the slower one. Moving averages are trail markers, not fortune tellers. They smooth noise so you can see the slope. Both markers are uphill from price. The trend is down. RSI comes first. RSI is the speedometer for the latest push. At about 42, it was neutral. No stretched reading demanding a reversal. Then MACD compares faster and slower price momentum. It sat at minus 13.8 against a signal of minus 10.7, below its signal line, so momentum was deteriorating rather than turning up. Those are related gauges, not independent witnesses. Both come from price. Counting them twice is asking the same friend for a second opinion in a different hat. Stochastic asks where the latest close sits inside its recent range. Around 19 was oversold. That raises bounce risk, but a stretched rubber band is not proof it snaps today. So far, you have a downtrend with possible bounce, not a confirmed turn. Now volume gets a vote. Money flow index is RSI that also checks who showed up. It weights each move by the volume behind it. Around 56, buying participation looked healthier than the price trend. That countersignal surprised me. It says participation leaned better, not who bought, why, or whether you should trust it. Chaikin Money Flow asks whether volume finishes near each day's highs or lows. Near negative 0.05, it was balanced, not confirming strong accumulation. Together, RSI neutral, MACD bearish, stochastic stretched, money flow index mildly positive, and Chaikin money flow balanced. They disagree, not a green light. Trend quality is choppy. ADX only measures how hard price is trying, not which way. 16 is barely trying. Picture someone pacing a hallway all day and getting nowhere. Point and figure strips out small wiggles, leaving a simpler supply and demand map. It showed a bounce inside a broader downtrend, with support around 540 and resistance around 615. Support is the floor buyers defended. Resistance is the ceiling sellers defended. Break the floor and the chart worsens. Clear the ceiling and recovery has evidence. Technical verdict, bearish and choppy, with bounce risk but no confirmed long setup. For you, the chart is the strongest case against an easy bargain. Now we resolve it. Meta's ad engine is strong, its quality record excellent, and current AI tools appear to help pay today's bills. The value case clears my normal bar. At the August close, the model offers enough to beat the basket we could own instead. But the stricter bar fails. The provider earnings basis has a limit I cannot close, and sellers control the bigger trend. Those are not footnotes. They are the condition. This is how I am playing it. Watch list, waiting for proof. I treat Meta as a split verdict, not a checkout button. The lower price earns your attention, not blind trust. Here is where I could be wrong. If the build permanently improves ads and creates new revenue, my old spending ruler fails. Meta could clear the stricter bar, and I was too cautious. The business test comes next quarter. Meta guided Q3 revenue to 61 to 64 billion. If revenue lands there while margin and free cash flow rebound, the bear case weakens. If ads stay strong but money left after the build stays near zero, or spending climbs again, the lower price is probably a reset for a heavier business, not a sale sticker. The calendar gives you 2 checkpoints. MetaConnect is confirmed for September 23rd. Earnings are estimated for October 28th after the close, but Meta had not confirmed that date. On the chart, I want the 50-day average reclaimed and 615 cleared before I call the trend repaired. Lose 540. The value argument can wait. Final answer. Whether Meta is cheap is not a fact about Meta. It is a question about how much cushion you want for a $140 billion a year build with no company-wide return disclosed yet. Great ad business, unproved build, bearish chart. Watch list, with receipts due next quarter. This is educational. My reading of public filings and a dated model, not financial advice or a recommendation to buy or sell. Do your own research. The assumptions are where this answer lives. If this saved you a few hours, give it a like and subscribe. That tells the algorithm to put the next analysis in front of investors like you. Tell me the next ticker you want pulled apart. Your call is yours. I will keep showing you the work.